For the last 3 years, the narrative of the AI boom has centered on a single gatekeeper. If a company wanted to build a large language model, they went to NVIDIA for processors. But the supply chain focus is shifting. A quiet, physical bottleneck has formed behind the scenes, nothing to do with processors themselves. The most cutthroat, high-stakes sector of the AI economy is now the memory chip. Micron's third quarter report for 2026 shows the scale of this shift. In a single quarter, it generated $41.46 billion in revenue, up from $9.3 billion just 1 year earlier. Even more significant is the profit, an 84.9% gross margin. For a hardware company that owns and operates massive multi-billion-dollar silicon factories, an 85% margin is a rarity. It is the level of profitability typically associated with software monopolies, not physical manufacturing. Historically, memory was a volatile commodity business defined by a 25-year cycle of boom and bust. During a boom, chip makers would spend tens of billions to build new capacity. The problem is visible in the historical pricing data. By the time those factories actually opened, the market would be flooded with chips. Prices crashed, and companies like Micron would plunge into multi-billion-dollar losses. These mechanics are rewriting the financial rules of the global chip industry. To see why this isn't just another temporary cycle, we have to look at the engineering forcing the change. The bottleneck stems from a physical constraint known as the memory wall. AI models calculate trillions of parameters simultaneously, but even the fastest processors sit idle if they have to wait for data to travel across a motherboard from standard memory. High bandwidth memory, or HBM, solves this by stacking 12 layers of memory vertically and mounting them directly next to the processor. This shortens the data path to a fraction of a millimeter. Years ago, South Korea's SK Hynix made a risky bet to pioneer HBM technology, investing in it before there was a clear market. When the AI boom hit, that gamble made SK Hynix the primary supplier for NVIDIA's AI hardware. By solving a microscopic engineering hurdle, memory manufacturers moved from providing a basic commodity to controlling a critical piece of the AI infrastructure. Producing HBM is exceptionally difficult. It requires up to 3 times the raw silicon wafers of conventional memory to produce the same number of units. As factory lines shift to produce these complex AI chips, the global supply of standard memory for servers and computers has tightened, creating a systemic price squeeze. To protect their own production timelines, tech giants are changing how they buy silicon. They are now signing multi-year take-or-pay contracts. Micron has already executed 16 legally binding agreements, guaranteeing a minimum $100 billion in revenue over 5 years. Customers are so concerned about future shortages, they've committed $22 billion in upfront cash just to reserve their place in line. These deposits and guaranteed volumes provide a level of financial predictability that didn't exist in the memory market 3 years ago. The industry is no longer waiting for orders. It is building against a massive prepaid backlog. This capital is funding a global expansion. SK Hynix is moving to secure its position beyond its home market in South Korea. Their $29 billion U.S. stock listing is designed to fund a massive build-out of American manufacturing capacity. Building a single modern memory facility can cost $20 billion. By listing in the U.S., SK Hynix is tapping into the capital needed to match the scale of the AI boom. This puts them in direct competition with Micron, which is currently expanding its own sprawling megafabs in Idaho and New York. This expansion on American soil ensures that the physical supply of AI memory will remain under the control of just 3 major players for the coming decade. The remaining question for investors is whether the industry will eventually overbuild and trigger another crash. Chip makers are now pacing their factory construction to keep the market undersupplied, maintaining their pricing power even as new facilities come online. Management projections suggest this shortage will last well beyond 2027. This is because a second wave of demand is arriving, localized AI processing at the edge. This includes autonomous vehicles and industrial robotics, which require massive amounts of local memory to process data in real time without relying on the cloud. By locking in billions in prepaid demand, memory manufacturers have moved from the periphery of the tech supply chain to its center. With valuations for these 3 firms now reaching the trillion-dollar mark, memory has transitioned from a cyclical commodity into the primary gatekeeper of the next era of computing.